All right, welcome to our webinar. We're excited to have our new resource partner, One Capital Management, with us. This is our second webinar with them in our five-part series. One Capital is a premier boutique investment advisory firm that oversees roughly $2 billion in assets, and they're located in Westlake Village, California. And today, like our last webinar, we have their two senior partners, Gary Dorfman and Eric Hamill, with us. And yes, Gary is Dr. Bill's brother and also his financial advisor. And it's been said that Bill creates the dentistry beauty, but it's his little brother, Gary, that ensures his financial plan and investment strategy. So they bring over 30 years of investment management and experience working at some of the premier firms on Wall Street. And Gary's been an innovator in the financial service industry, creating wealth management platforms for several large financial institutions. We're grateful for them, thankful to be together, and they've actually created this webinar series specifically designed for Crown Counsel. So we're grateful to have them, and we'll turn the time over to Gary and Eric for part two of our series. Thanks for joining us, guys.
Great, thank you, Stuart, and hello to everybody. Hope everybody's safe and families are doing well in this, crazy, difficult time. Well, welcome to the Eric and Gary show, if you will, coming live here from California. And so last webinar, we really focused on some of the keys to being fiscally successful, responsible, making good decisions, how you should think about planning, how you should think about things like asset allocation, asset location, market timing. Today we wanted to narrow in on change, and change from the perspective of what are the questions that you should be thinking about in the relationship that you have with your financial advisor. How do you make smarter and better decisions around your money? And so that's what we really wanted to focus on today. And we're going to walk you through what we think are, as indicated on this title, what the change questions that you should be asking your financial advisor today. So the first one, which will pop up here any second, and so this is in the sequence of change. Actually, why don't we do the first two, change and how your advisor gets paid. And so for many people, and as Stuart mentioned, I've been doing this for 30 years and have worked with a wider range of clients, from large endowments and foundations to individuals, their families, their trusts. And we've done a lot of work with their children and educating their children for succession planning and things like that. And I think one of the greatest misconceptions and misperceived components of investing is, what is the real cost that you're paying for investment management or financial planning? And then how does your investment advisor, how do they get compensated, and how are they structured? And so it's important, I think, to get a really good understanding of that. And so at One Capital, what we believe is critically important is complete transparency. And so in developing a relationship, or the relationship that you have with your financial advisor, you should be having conversations about, either on a quarterly or annual basis, on what the cost is of the services that you're paying for, and what ultimately you're receiving. So I put together a little example. I think this will take us to the next slide. So I know there's a lot on this page, but this just gives you an idea of how we present our overall costs to our clients. And some format of this is what you should be looking for from your advisor as well. So there's brokerage firms, and they get paid a commission when they're recommending a transaction, and you should understand what the commission structure is and what the fee is that you're being charged. And then in firms like ours, which we're a registered investment advisor, and we act as a fiduciary in the very best interest of our clients, we charge an investment advisory fee. And we want to be completely transparent. So a portfolio will typically consist of individual securities, mutual funds, ETFs, maybe some alternative investment strategies. And there's a cost to each one of those investment strategies. And many times those costs aren't really being shared with our clients. And we found in the analysis and the evaluation work that we do on their portfolios, they typically have no idea, or you have no idea, of what the overall cost is. So this is a sort of a sample portfolio. We use outside portfolio managers, we use mutual funds, we use internal portfolio management. And so this breaks down the different categories, but I think what's most important here is what it shows is the value of each one of the asset classes and strategies selected, what percentage from an allocation perspective is being invested in that individual strategy, and then the underlying fee. And so if you go to the all the way sort of scroll down to the bottom, what you'll see is the blended fee. And so that's the total fee of what the managers or mutual funds cost are. And mutual funds are a little bit tricky because there's front-end loaded funds, there's no loaded funds, there's expense ratio funds, and many times advisors don't disclose what the fee is. And we think it's critically important that those fees are disclosed. So in this hypothetical example, as you'll see, the total blended cost of the portfolio management component, the actual investment strategies that are being utilized to manage your portfolio, again, after we've done the planning, after we understand what's important to you, your goals, your objectives, what you're trying to accomplish with your financial assets. But the total cost of the portfolio management, as you see on this example, is 0.42%. And then we disclose our advisory fee, and our advisory fee is for us to do what we do, which is oversee the portfolio, select the individual portfolio strategies, ongoing research, monitoring, due diligence, all the financial planning work that goes into creating the right portfolio strategy, and then of course the ongoing working of the relationship to make sure that you're staying on track to meet your long-term financial goals and objectives. So on this portfolio, the fees, and everyone's different because we customize each portfolio to each individual client situation. But as you can see on this individual portfolio, the fee came out to be about 1.2%, and that's all in. So one of the most important questions you want to ask your advisor is, what is the total annual cost that I'm paying for the portfolio management services? Meaning everything, if there's commissions, if there's expense ratios to the mutual funds, and that way you'll really have a good idea of what you're paying and then can assess, am I getting essentially what I'm paying for? And to give you an idea of what this means in real dollars is we created an example for all of you. And many times in the investment business, we talk in percentages, right? The S&P returned 8% for the year, or the Dow Jones returned 12% for the year, or the EFA index had, an X amount percent return for the year. And percentages are a little bit misleading in that it doesn't always equate to what the real dollars is. That's on your guys' side. I was checking. Eric and I were checking our cell phones over here. But anyway, and so I wanted to show you just what a 1% difference is, because if you think back to that slide that I just showed you, at 1.2%, that's a pretty competitive all-in fees. We've seen fees as high as 2 and 3%. So if you look at an investment amount of $500,000 and over a 20-year period, and there's just a 1% difference. So let's say you're not getting 1.22%, you're getting 2% or 2.5%. As you can see, 6% return versus a 7% return, so netting out that 1% fee, has a pretty dramatic difference. Over a 20-year period, your $500,000 at 6% would have grown to $1.6 million, as opposed to at 7%, so again, a 1% difference, would have grown to $1.9 million. So over a $331,000 difference just by a percentage point. So again, this is to narrow in on and to just sort of make you aware of the importance of what the overall fee is that you're paying on your overall portfolio, because that's going to have a big impact on ultimately what your net return is, and then what your portfolio actually grows to, which is what this example highlights. So with that covered the C and the H in change. And now I'm going to turn it over to my good partner, Eric Hamill, and he's going to take you through the A, N, and G part of change. So thank you.
So again, welcome everyone. And just to piggyback on what Gary was just saying, another area that we often find missing on the cost side is when you're working with someone on insurance products, annuity products, and those types of things. Those have a bad rap for a reason. Obviously, they're not all bad products. A lot of them can be very good products, but you want to talk about hidden fees, surprises, negative tax surprises, and the like. Those type of products are often riddled with misunderstandings. And the unfortunate part is people don't usually figure that out until the end. I'll give you one example. I met someone who had been investing for 20 plus years. They were looking at retiring, and they came in to do their financial plan. Never too late to do a plan, but I started the conversation with, please don't shoot the messenger. And when I looked at their situation, what they thought they had invested in was not anywhere close to what they had invested in. There are some financial products these days, and you see the paperwork on these is like this thick. And part of the letters, the spaghetti letters after my name, is that I can read through all those and tell you which ones are good, bad, and why. One of the problems are the hidden costs, the hidden gotchas, or the misunderstanding of how they work. Probably the most noteworthy one that most people have probably heard of are called indexed products, such as indexed annuities, or these fancy annuities that you can't lose any money on, but you can make a bunch of money on. They're very easily sold and explained in that fashion, but the reality is the vast majority of the time, they're not even legally investments. So again, understanding what something is and why it's appropriate and how that person is getting paid for it, it's not surprising those products pay an extremely high commission. So again, just being aware of what these things are on the upfront can save you a lot of heartache down the road. So getting into the A part. So I'll start with, that's an addition, but the real A here is asset allocation. And don't let your eyes glaze over yet. A lot of people talk about asset allocation, diversification, these words that get thrown around in our industry to the point where some people just hear that and they shut off. What I'm going to point out is going to be a lot more straightforward. Number one, assuming you actually have the right asset allocation, which is a whole different subject in and of itself. How is it being managed? You should be asking whoever is your steward of your finances, how is that allocation being managed? Just as surprising as the cost can be, the how can be just as eye-opening. I'll give you an example. Many times we'll get referred to someone, we'll look at their portfolio and go, when's the last time a meaningful change was made here? Just because they're getting charged fees doesn't necessarily mean, to Gary's point, are you getting what you're paying for? And a lot of times it's technological limitations. And I'm not going to pick on any just one company, but you pick any of the biggest names that are out there. A lot of those financial companies are built on decades old technology. Now, I'm not an IT person and I'm not a dentist, but I'll give you two analogies here. One is a friend of mine who said, you know what? When I see ads from these financial companies as a coder, I just laugh. I go, why do you laugh? He goes, because they don't even teach what they're asking for in school anymore. That's how outdated their systems are. And people wonder why they get hacked all the time. So how does that fit into asset allocation? Well, pretty simple. It's kind of like flossing. Everyone knows you're supposed to do it. Number one, are they actually doing it? Number two, if they're doing it, are they actually doing it correctly? And in our view, correctly means not just ad hoc once a year just because I'm charging you a fee, I'm going to rebalance your account. There's no science behind that. That's not effective wealth management, but that's most often what's happening. So when you take a deeper dive into someone's portfolio and you look at the technological limitations and you look at the physical limitations of what they're trying to accomplish, often these pieces are being missed. For example, at One Capital, they spent a lot of time on the technology side up front to make sure that they could have an extremely efficient way to rebalance and allocate client portfolios over time. So for example, say you have, and I'm going to oversimplify this, half your money in stocks, half your money in bonds. Well, stocks are different types of stocks. Bonds are different types of bonds. Literally every single day, our systems are monitoring to see if what the advisor and the portfolio team structured for that client gets out of whack by any certain amount in any certain category. If it does, it flags the human trader eye to look and say, oh, it's cause for concern or cause for opportunity, make an adjustment. So nothing gets missed. Now, you don't just leave it 100% on autopilot, because then you see all the craziness you can see in a portfolio like we saw at the end of 2018 and we saw earlier this year, where a lot of the algorithmic-based trading platforms had a lot of problems. So in our opinion, it's the best of both worlds. Maybe 10 years from now, algorithmic trading might make more sense for a firm like us. I don't know. What I do know is where we are today between technology and human capability and bringing the best of both worlds together. Because it's the how this stuff is happening that's going to really make a difference. The last example I'll give you on that is a very simple one, but it's very impactful. I've met people that said, Eric, I don't understand. I started with the same amount of money as this person. We had similar amounts of stocks and bonds. Why are we so drastically different? We've been friends for years. I don't understand why I'm better off or they're better off considering all these things. And oftentimes it comes down to their allocation. They may have the similar mix overall, but if you have $1 million and you lose 10% and you gain 10%, where are you? You're not break even, you're negative, right? You go from 1 million to 900, 900 to 990. So how you're rebalancing and smoothing those rides out along can make a dramatic difference. Forget about when you actually retire. The reason a lot of people's financial plan will fail in retirement is because their allocation was wrong going into retirement. They had the same allocation going into retirement as they did leading up to retirement, and the math just simply doesn't work well. It's not my opinion, it's just math. If anyone wants a deep dive, email us, I'm glad to go through it. But that's where I'm gonna stop on the A piece. So that brings us to the end, which is new strategies. This year is a huge one. We've had more tax and financial changes in the last couple of years than we've had in the last decade, maybe even couple of decades, depending on which part you look at. Between the Secure Act, the CARES Act, there's Tax Cut and Job Act, there's so many different things that have happened, and they each carry a substantial amount of changes, right? And I could spend literally all day going through those, which I'm obviously not gonna do here today, but let's just say this. The world we live in, the only thing I can guarantee on this webinar is that something will change, right? It'll be taxes, it'll be finances, it'll be the pandemic. Certain things will absolutely change, and it's a fool's errand to try and assume you know what's going to happen. So by creating the right strategies, you want to build in flexibility into your plan. As an example, one of the things I touched on briefly in the last webinar was new strategies around the 3 different types of tax buckets any of us can have, right? The fact that, and if you weren't on the last one or you didn't see it yet on the video, we suggest you watch it. But the bottom line is there's the only 3 different types of accounts any of us can have, period, end of story. Any asset that you have in this country has to fit in one of these 3 buckets. Most of the time, people don't even have all 3 buckets. Even if you're fortunate enough to be doing that, there are so many opportunities in each one. I mean, every industry has its lobbying efforts, right? And I'm not saying it's good or bad. I'm not here to judge. All I'm saying is it exists. Are you taking advantage of what's available to you, right? Most people here are business owners. They understand there's a lot of things for business owners. There's also a lot of things for oil and gas. There's also a lot of things for real estate. There's also a lot of things within certain tax type accounts. Are you aware of all the opportunities that are available to you? Because many of them have massively changed in the last few years. And so often we get referred people, we're looking going, wow, that was a missed opportunity. That was a missed opportunity. I'll end this section with one example. Last year, I was referred this client. They were just retiring, and they had a very big payout. They had kind of like the portfolio earlier, $7 million invested, and they met me in November of last year. Had they not met me, they would have paid an additional $500,000 in taxes. Keep in mind, they had a great CPA that they had worked with for years. They had a great attorney who had done their living trust and the regular documents, yet the estate plan and the tax side were not linked into their portfolio side, and they were about to leave $500,000 on the table. We barely, with the times constraints before the end of the year, were able to do some of the strategies like tax exempt trusts, other things that were able to save them $500,000. So ask your advisor, hey, what else should we be looking at this year? Because just like you can only work with so many patients. We can only work with so many patients. Ask them, how many people are you working with? What kind of clients are you working with? You want to make sure it's the right fit for you and your situation, because there's no do-over with this stuff. So I'll end there as far as the strategies are concerned, because again, we could go on and on about specific examples, but I think that kind of illustrates the point. So that brings us to the G section, which is gain. And I hope you have a gain this year. And, gain is a word that we use a lot in this industry. There's different types of gains. In fact, one of the other things that's going to be changing one way or the other this year is taxes again, right? I don't care, this isn't a political thing, but the fact is each side has their tax plan. Each one has substantial ramifications as it sits here today. Based on what's been proposed thus far, those are huge differences and can affect many people many different ways. So you want to start thinking about, how are you going to be taxed this year? How are you going to be taxed this next year? How does that fit with your portfolio? Going back to the allocation piece, if you get to the gain side, that presents an opportunity. Earlier this year, were you tax loss harvesting in the portfolio? If not, why? Again, was it technological constraints? They physically couldn't do it in a meaningful way? Because if you have non-IRA, non-401k money and you did not do tax loss harvesting this year, very likely there's missed opportunity there. And on the flip side, whether it's this year or a year in the future, there might be an opportunity to move money over the line and buy out the government on some of your tax assets, whether it's IRA, 401k, non-IRA money, in a zero or very tax efficient manner, if you do it on purpose. And so often we see these things being left on the sidelines. The example I gave before was someone almost missing out on tax savings. There's also such thing as purposely recognizing taxes at a correct way. So you want to make sure that's incorporated in your portfolio in an incredibly efficient manner. There's tax loss harvesting, tax gain harvesting, Roth conversions. So ask the advisor, what did we do this year? If so, why? If not, why? And then what are we looking at the end of this year and next year? Especially under both scenarios should already have been played out. What the left is looking at, what the right is looking at from a tax and investment proposal, and how that should back into your portfolio. So with that, I'm going to kick it back to Gary for the last section here. And well, I should just pause right here. We put this slide in here, but again, to Gary's point about percentages, we just wanted to illustrate the difference as far as that rebalancing technology. I'll just sum it up for you. Between 6 and 32% roughly of your net return difference based on the data and studies that have been done. That's the kind of swing you can see in your net returns from the things that we're talking about here, okay? So that brings us to E.
Thank you, Eric, thank you. And let me, expectations. So, I was thinking about this, and I think in life, whatever type of relationship you go into, you have a certain expectation. And expectations should be discussed and should be effectively managed. So I was thinking about it in context to dentistry. And I know my older brother does a lot of work around porcelain veneers and works with some of Hollywood's biggest and best. And of course, they have certain expectations of what they want their smile to look like, right? So what the coloring and shape of the veneer is are two really critical components. And so I know in the initial consult that he has with potential patients is to come up with an understanding of what is really important to them and what their expectations are and what their goals are. And that's how he has been so successful in getting a positive result with the many, unbelievable clients that he's had the opportunity to work with. That is very similar to what should be done as it relates to financial management, your assets, and how your assets are ultimately being managed. And so the most critical component, I think, of expectations is just having an open and honest conversation with your advisor of the things that are really important to you. What are you ultimately trying to accomplish? What are you trying to achieve? What are your goals? What, if any, are some of the concerns that you have? And then managing and having a forum to manage those expectations on an ongoing basis. So I've highlighted a couple of the bullet points here, and some of those expectations should be, what is your goals and objectives? And then how effectively is your plan doing to ultimately meet those goals and objectives? And again, having either a quarterly or an annual meeting to sit down and talk about, again, what the expectations are, if anything's changed in your life, and again, are you satisfied with what's being done to ultimately meet those expectations? You should also understand how the company is that you're working with is structured. If your advisor, depending at where he is in his career, if he has a succession plan. I know in my particular case, I'm actually getting close to the big 6-0, which is, something that is, I never thought would happen as quick as it has, but it has. And I plan on, I love what I do, and I plan on being very involved in business for the next 5 to 7 years. But part of the benefit of working with Eric as my partner is Eric's in his late 30s. And so we have a succession and a continuity plan in place so that our clients for many years are going to continue to get the level of service that we're currently, providing them. Eric touched on the idea of other advisors, and this really is more important as your assets grow and the complexity of your assets, but making sure that your portfolio and your investments are not just being managed in a silo is critically important as well. So what's going on the tax side, and is your CPA and your investment advisor, are they coordinating so that we can, most effectively manage the tax implications and tax consequences of your portfolio? How is your estate plan being structured? What is the succession plan? What is the tax implications of that? And so those are all critically important, again, in making sure that the overall plan is meeting your goals and your expectations. And so the way we do that, which is indicated in this last bullet point, is we offer our clients quarterly meetings or semi-annual or annual. We're very flexible and it's customized to each one of our clients, but we try to have a meeting at least once a year. We do a lot of planning up front. We create a financial plan and goals and objectives and realistic expectations. So the importance of that meeting is to review your plan and to assess if you're still on target. To also have conversations about, has anything changed in your financial life? Are you planning to retire in the next 3 years or 5 years? Or perhaps are you looking at potentially selling your practice? And so those are all things that have a big impact on, again, the strategy, the plan, and if your expectations are being met. And then ultimately, are you on track? So hypothetically, if you're going to retire in 10 years and you want to live on $250,000 after taxes, is the plan that we have in place today, is it still the best plan to do that? So these are all really important conversations that you should be having with the financial advisor, the firm that you're working with. Again, and it gets back to probably the most important component of what any good advisor is doing in working with you is making sure that you have the right plan for you, not a boilerplate plan that is just, okay, fill out a questionnaire and you should be in this model portfolio and then, bye-bye and we'll talk to you in a year from now. you want to make sure that your client, that your advisor is communicating, that you're having open and honest conversations with them, at least on an annual basis of what's going on in your financial life, what's going on in your real life, so that they can make the right decisions and help guide you down a path of financial success. So with that, we'll certainly open it up to any questions on financial markets, anything that anybody is interested in, curious. And then I just wanted to remind everybody that as we did in our first webinar, we've provided, and I think Spencer has sent out, there's a no-cost financial assessment that we're providing for Crown Council members. I think it's a tremendous value. Typically, to create financial plans, depending on the level and complexity, it's $2,500 to $5,000. This isn't going to be a full financial plan, but it will certainly identify and highlight important issues that you should be considering and thinking about, and that we'd be more than happy to provide additional input or feedback on that particular assessment. So with that, I'll flip it back to you, Stuart, and see if there's any questions.
Sure. Spence, anything to add?
Just to reiterate what Gary has mentioned there, we are looking forward to providing all this information today via email, along with that assessment again, and welcome everybody to jump in and participate. Just a shout out to Gary and Eric for their time. I'm loving the sessions here as much as anybody. So good. Thanks for your time today. Open it up for any other questions. Yeah.
I'll be sure to include the assessment in the email, and it's on the webpage that's hosted on the Crown Council website, so anyone can access that document. Gary and Eric, what's the best way for Crown Council members to connect with you? Just a simple email or phone call? What's best?
Yeah, I would say either, and you have our contact information, and so either Eric or I, we work very closely together, and so dropping us an email or a call, whatever's more convenient.
Okay.
Great. Gary, here's an interesting question here that came in. How do you know if your financial advisor and tax planner are well matched?
That's a good question. So my perspective, and then I'll let Eric, because we both have a lot of experience with that, is when we're first establishing a relationship with a client, we want to know who their key advisors are, and so they provide that information. So then I'll typically call both their CPA, business manager, or estate planning attorney to have an introductory call and to understand how they're working with that particular client, what their approach is, what their philosophy is, where they're adding value. And, from that conversation, and then, quarterly meetings and bringing them up to date on, the quarterly meetings that we've had with the clients, we could get a pretty good sense of if it's a good fit, and if the, whoever the other advisor is, the CPA or business manager or estate planning, is a good fit, works effectively well together with us. And, it can be a sensitive topic, quite honestly, because some clients have relationships with, I had a client, for example, that had a relationship with a CPA that goes way back, and she really liked the CPA and had a personal relationship, but it wasn't a CPA that had the skill set and the expertise, quite frankly, to deal with the complexity of her financial situation and the tax implications. And so over a period of time, in having conversations with her, I would just, because my focus is on the client and doing what's in the very best interest of the client, and certainly not in a negative way, but I would bring up certain things that we would want to be considered as it relates to the tax management of the portfolio, and what was being provided from a tax service perspective and wasn't. And then ultimately it would be, hey, if you have a great relationship and you want to keep that relationship, you need to understand that you're giving up a little bit on the service and the depth, in this case, of the resources that's being provided. Ultimately, it's Mr. or Mrs. client, it's your choice of what you feel more comfortable with. But as your financial advisor, I just want to make sure that you're aware of, there could be things done that sort of enhances how your overall financial situation is being managed. So great question. It's a little bit, the balance is a little bit tricky, but we certainly want to make sure that we have the best advisors. Sometimes the clients are, okay, we're happy and we understand, or, let me meet a couple other CPAs, for example, that you would introduce me to and see how I feel comfortable and where they could add additional value.
And just a quick acid test. Ask both of them separately. Would you refer so-and-so to someone that I'm thinking about referring? Ask them both. See what they say. That will be very telling in and of itself, because if they even hesitate as far as referring people to the other side, that should say something in and of itself. Secondly, as a dentist, you're only as strong as your practice is only as strong as your team members, right? And obviously that's just as true in our business. And in a similar way, it's hard to get the right team members, right? And that can evolve and change over time. Whether it's like Gary mentioned earlier about succession planning, or you just want to take your practice to another level, it's the same thing when it comes to what all these different advisors are doing. So have you ever had a tax surprise would be the other question I would ask. And by the way, that could be negative or positive. And if so, you want to look back on those experiences and go back to that person and ask why. Was it a portfolio surprise? Was it a tax surprise? Was it a legal surprise? I can't count the number of times where we've been referred a client and we've looked through their situation and there are holes missing. Not by anything, malicious, just, unfortunately things get missed. And it's good to have multiple sets of eyes on things. Going back to the example I gave earlier of that $500,000 last year.
And then I would say finally is just the awareness, which, we're highlighting here, of having that conversation, right? Of saying to your financial advisor that you want to make sure that they're in communication with your CPA or with your estate planning attorney, because there's been changes to your trust or whatnot. So that's part of, really your role and responsibility in making sure that you're bringing the awareness that needs to be coordinated, and that going back to the expectations is you don't expect your portfolio and your financial plan to just be being managed in a silo, that you understand that to ultimately get the most benefit of the plan, there's a coordination between your other professional financial and investment advisors.
Great question.
Yeah.
Good answer. Good. Very good. Okay. Well, if there's any other questions, I'll pause here for 1 sec, and then we'll just wrap up the recording and plan on webinar 3 in the next couple weeks.
Looking forward to it.
Sounds good.
All right. Thanks, everybody. I'm going to shut it down. I'll post this to the Crown Council website. Grateful to be with y'all.
Thanks, guys.
Thank you.
Be well.
Have a nice weekend.
Thanks.